Economic calendar, US data release, and a dip in the Kiwi. Let's wrap up the week with Bob Mason from FX Empire. So how is this week looking in terms of the economic calendar?
Economic data through the week has been finely balanced, really. We've seen, negatives and positives aligned. Out of the US, we saw at the beginning of the week, factory orders take a hit. But then when we moved across to ISM non-manufacturing numbers, they were positive, and that's very important for the US economy. Service sector activity accounts for 70%. So a boost in, new orders and employment was a positive in the, when we're looking at the details. Trade data narrowed, but, the deficit narrowed. But then when we look at the JOLTS job openings, they fell as well. So that was a negative. But then when we look at the underlying detail, the quit rates, which is very important, they were relatively steady in September, suggesting that confidence within the labour market remained high. We go across to the Eurozone. We saw the PMI numbers, come out in the composites this week. We saw the Eurozone composite rise slightly, but the reality is that in October, the composite and growth remained close to 6.5-year lows that we saw back in September. And, that's coming with new orders falling for a second consecutive time. Out of Germany, we saw factory orders get a boost, suggesting that, we could see industrial production rise in October, which would be, quite handy for the Eurozone. But then as we saw, industrial production fell in September. So, Germany's still under the hammer, and, that's causing a bit of stress. Then we go across to Asia. We saw Australian retail sales take a dive as well. We've seen the RBA have significant concerns over domestic consumption. And as we saw in their quarterly statement of monetary policy this morning, they downwardly revised growth forecast for this year, really attributed to weak wage growth and slow consumption, weaker than had been expected. So all in all, the numbers were, balanced, but the reality is that things were not great. So all in all, while the numbers were finely balanced, between the positives and the negatives, it was a weak week in terms of economic data, particularly from the Eurozone.
As usual, the US released its data in the first week of the month. What did the microeconomics reveal to us?
So from the US, it was a mixed bag on the economic data front. As I mentioned, we saw ISM non-manufacturing numbers rise. That came off the back of, rising employment and new orders. So that's a great bit of news for Donald Trump, and the US administration, that, the fact is that while service sector activity has seen slower growth since the trade war began, it has managed to hold its own. That's really in contrast to the manufacturing numbers that, continue to paint a very different picture. As we saw, the factory orders fell in September, and things aren't looking great for October, really. Looking at the job, labour market conditions, the JOLTS numbers did fall, but quit rates, as I mentioned, did hold steady. So, that is a positive. And, we saw non-farm payrolls impress, and the weekly initial jobless claims came in at 215K on Thursday for last week. So that's also decent, for the US. So all in all, pretty good for the dollar. Obviously, the real boost has been progress on the trade war. The fact that, they are talking about removing some of the tariffs and a phase one agreement in sight, that's dollar positive at the end of the day. We should see manufacturing sector activity in the US improve should these tariffs come off and China and the US actually find some common ground.
The Aussie managed to make gains this week, but its neighbouring Kiwi managed to make losses. What do you think was the cause for this decline?
Well, the Aussie dollar managed to hold on to positive territory. By Wednesday's close, the Kiwi dollar was under the hammer. Economic data out of New Zealand was limited to third quarter employment numbers. We saw the unemployment rate rise to 4.2. There wasn't too much of a hit on the Kiwi, however, because the underutilization rate fell to 10.4%, which is the lowest since the second quarter of 2008. The reality remains, however, that expectations are for the RBNZ to be delivering a dovish message, next week. Monetary policy, is against the Kiwi dollar at the moment. Expectations are for more rate cuts to come. That's in contrast to the Aussie and the greenback, where both the RBA and the Fed are now expected to stamp pattern policy. So Kiwi dollar pressure for now should remain. This morning we saw the Aussie dollar fall back into the red, however, after the quarterly statement of monetary policy from the RBA, that hinted at, weaker growth forecasts for this year, wage growth and consumption being major issues that may raise the prospects of further rate cuts to come. But for now, the RBA is unlikely to move, considering the interest rates at record lows.
So, Mr. Mason, thank you once again for joining us this time, and we will see you again very soon.